Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
$31.38. That's the number glaring at us from the screens for HIMS and HERS Health, ticker HIMS, as we sit here in mid-January 2026. And if you zoom out, the chart is painting a pretty brutal picture. We've watched a massive retracement from 52-week highs that were nearly touching $73. Technically, the setup is just ugly. We are looking at a textbook death cross. That moment when the 50-day moving average, currently at 36.43, crosses below the longer-term 200-day average at 45.77. For the technicians out there, that's usually the definitive signal that the long-term momentum has completely shattered.
And the volume tells us that people aren't just watching this happen. They are actively participating. We're seeing average daily volume hovering around 15 million shares. That's heavy turnover. I mean, there's liquidity, sure, but it's liquidity born of panic. Investors are heading for the exits. The central tension here isn't just about a stock chart, though. It's existential. Is this company a broken growth story that's about to drive off a regulatory cliff now that the GLP-1 shortage is officially over? Or is the market completely mispricing a profitable platform that is pivoting, albeit painfully, toward personalized medicine?
That is the core question. And I see why you frame it as a cliff, but I view it very, very differently. I see this sell-off as a massive overreaction, a total disconnect between fear-based sentiment and the actual business fundamentals. To me, HIMS right now is a coiled spring. We're looking at a company that has been punished as if it's failing, yet the underlying metrics suggest it is just gearing up for its next phase. So yeah, I represent the bull case here. The market is fundamentally misunderstanding the personalization strategy, and the short squeeze potential is immense.
And I come at it from a different angle. I'm representing the bear case. I think the regulatory arbitrage window, that period where they could basically print money by compounding semaglutide because of FDA shortages, that window is nailed shut. The valuation is still too rich compared to its peers, and the risks facing their margins in 2026 are very, very real. This isn't a coiled spring, it's a value trap facing an identity crisis.
Okay, let's get into the position statements then, because I need to address that identity crisis claim right away. The market is behaving as if HIMS was just, a pop-up shop for Ozempic knockoffs, completely ignoring the fact that this company achieved its first full year of GAAP profitability in 2024. That's real money, not adjusted EBITDA fluff. Look at the most recent numbers. Q3 2025 revenue was up 49% year over year to $600 million. That is not a company that's dying. That is a company that is scaling.
Scaling revenue is one thing. Scaling profit in a post-shortage world is a whole other ballgame.
But the quality of that revenue is changing. The HERS vertical alone, focused on dermatology, mental health, hormone therapy, is projected to hit $1 billion in revenue by 2026. That proves they've transcended the erectile dysfunction origins and the weight loss hype. And regarding 2026, I know the street is worried about the capital expenditures. They're calling it an investment year. But that CapEx is necessary to verticalize the supply chain. They are building their own 503B facilities, large-scale outsourcing facilities to control their own destiny. That is a sign of strength, not weakness. And let's not ignore the technical setup here. Short interest is sitting at roughly 32.6% of the float. Days to cover is exceeding 4 days. The negativity is so crowded that any piece of positive news triggers a vertical move.
That's a compelling argument for a trade, maybe, but I don't see it as an investment. I'm sorry, but I just don't buy the idea that the investment year is anything other than a margin crunch. Let's look at the reality of the regulatory landscape. The FDA declared the semaglutide shortage resolved way back in February 2025. The grace periods expired months ago. That regulatory arbitrage allowed them to print high-margin revenue because they didn't have to pay the massive R&D costs of the branded drugs. That free lunch is over. Now they have to compete on a level playing field, and the valuation just doesn't reflect that yet.
They are trading at 4.0x forward sales. That's hardly nosebleed territory for a tech platform growing at almost 50%.
Compared to what, though? Teladoc is trading at 0.54x sales. LifeMD's at 1.1x. If HIMS growth slows down because they can't sell these easy-access compounded drugs anymore, the stock re-rates to match its peers. That's a potential 50% to 80% haircut from where we are now. Bank of America just cut their target to $29 because they see exactly this. Capital expenditures are going to depress EBITDA, and the growth story stalls. And look at the insiders. You got to watch what they do. Executives like Irene Becklin sold over 8,000 shares in December 2025. They're hitting the bid even as the price drops. If the coil is really springing, why are the insiders bailing out?
Insider selling happens for 1,000 reasons. Taxes, buying a house. But let's dig into the core debate here, because the regulatory aspect is where all the heat is. You mentioned the shortage resolution, but you are glossing over the pivot to clinical necessity. This isn't HIMS ignoring the FDA. This is HIMS utilizing a legitimate legal framework.
It's a risky cat and mouse game, though. Let's be precise here so everyone understands the gravity of this. The FDA explicitly warned in January 2026 about compounded GLP-1s with additives. They are watching this like hawks. The strategy HIMS is deploying, it relies on this idea that if you add, say, B12 to semaglutide, or if you offer a 0.75 mg dosage, which the branded manufacturers don't offer, it falls under the clinical necessity exemption of the FD&C Act. Basically, they're arguing we aren't copying the drug, we're tailoring it.
And that is a valid medical argument. It's not just some legal hoopla, it's actually better care. Think about it from the patient's perspective. The branded drugs often force you to jump from a 0.5 mg dose to a 1.0 mg dose. For many people, that doubles the side effects, the nausea, the vomiting. Offering a 0.75 mg dose allows for a smoother titration. That is the very definition of clinical necessity. And because HIMS is verticalizing their supply chain, building those 503B facilities, they can manufacture these specific dosages at scale. They aren't relying on the shortage excuse anymore. They're relying on the personalization value prop.
But does the FDA agree? That is the billion-dollar question. We saw the Outsourcing Facilities Association versus FDA lawsuit try to challenge the shortage resolution, and sure, it bought some time, but the judicial deference to the FDA is returning. The courts are hesitant to second-guess the FDA on these drug supply issues. If the FDA decides that adding B12 is just a smokescreen to bypass the essentially a copy rule, they can shut down the 53B facilities supplying HIMS overnight.
Overnight is hyperbolic. The legal process is slow, and HIMS has the resources to litigate this. But more importantly, they aren't planning on just relying on compounding forever. This bridge year is about moving customers to a stickier, more holistic platform. They capture the patient with weight loss, but they keep them with mental health and dermatology.
The problem is that pivot is expensive, and the competition is not sitting still. And this brings us right back to the investment year trap. You compare them to LifeMD earlier. LifeMD recently divested WorkSimpli to become a pure-play weight loss bet. They're lean. HIMS is trying to be everything to everyone, and that costs money.
But HIMS has the balance sheet to do it. They are self-funding this vertical integration. Look at LifeMD. They're smaller, they have less cash flexibility. HIMS has 74% gross margins. That's software-level margins in healthcare. That profitability insulates them from the liquidity crunch that's going to kill these smaller players.
You say they're insulated, but just look at the private markets. Look at Roe. Roe is their closest private analog. As of January 2026, Roe shares in the secondary markets are trading at a 71% discount to their 2022 peaks. Why? Because customer acquisition costs, or CAC, are rising across the board. The GLP-1 gold rush is over. Now you have to fight tooth and nail for every single customer. If Roe is seeing its valuation collapse, why should HIMS be immune to the same market forces?
Because HIMS is public, it's transparent, and it's profitable. Roe is still this opaque black box. But let's talk about the catalysts, because markets look forward, not backward. You're completely ignoring the Novo Nordisk factor.
Ah, the will they, won't they partnership rumors?
It's more than just rumors. There is active talk about a potential partnership for oral Wegovy. We know HIMS was at the table before. If HIMS secures a deal to distribute the official oral formulation from Novo Nordisk, the entire regulatory risk argument just vanishes. They become a legitimate distribution partner for the biggest pharma company in the world.
Okay, but why would Novo share the pie? They have the most in-demand product in the history of medicine. They don't need HIMS.
They need distribution if supply normalizes, and this is where I start looking at alternative data. Have you looked at Polymarket?
I track it, yeah.
The prediction markets on Polymarket are showing extremely high confidence in Novo Nordisk's supply chain normalization. The crowd is betting that the shortage is truly over, and supply is about to become ample. If supply is ample, the bottleneck shifts from manufacturing to distribution. Novo needs to move units. HIMS has 2.5 million subscribers. It is the perfect marriage.
That is an optimistic reading of the data. I look at Polymarket and I see different macro headwinds. Look at the contracts regarding interest rates. The markets are predicting no rate cut in early 2026. HIMS is a long-duration asset. Its value is tied to cash flows years in the future. If rates stay high, the present value of those cash flows stays low. That hurts the valuation multiple, regardless of what Novo does.
I think the specific company catalyst outweighs the macro rate environment here. But if we want to talk about immediate market structure, we have to look at the dark pools. This is where the story gets really interesting for the bulls.
Dark pools activity is high. I'll grant you that.
It's not just high, it's astronomical. On January 15, 2026, the FINRA short volume ratio in dark pools hit 55.92%. For those listening who don't spend their day staring at the tape, dark pools are private exchanges where institutions trade to avoid moving the public price. When you see over half the volume happening there marked as short, combined with the stock holding that $30 level, it often signals institutional accumulation. They are soaking up liquidity, buying shares but marking them short temporarily for liquidity provision or hedging. It looks like smart money loading the boat.
Well, it's market makers hedging. We know retail is buying calls. The put-call open interest ratio is 0.75, which is bullish, sure. But that means market makers are shorting the stock in dark pools to hedge their exposure to those calls. It doesn't necessarily mean institutions are buying the stock for the long haul. It means they're managing risk.
But look at the sentiment. Retail on StockTwits is overwhelmingly bullish.
Retail hope is often a contrarian indicator, my friend. When the little guy is screaming buy the dip and the chart is showing a death cross, usually the chart wins. The technical trend is down. The stock is below the 200-day moving average. The support at $30 is precarious. If that breaks, we are looking at a flush down to $24, the 52-week low.
And if it holds, if that support holds and we get one piece of good news, a Novo deal, a beat on earnings, that 32% short interest has to cover. And with volume at 15 million a day, buying back 67 million shares takes a week of straight-up panic buying. That pushes this stock to $45 or $50 in a heartbeat.
That is the definition of a gamble, not an investment. You're betting on a squeeze to bail out a deteriorating fundamental picture.
I'm betting on a profitable company that the market has terrified itself out of holding.
Let's wrap this up because I think we've laid out the battlefield pretty clearly. For me, HIMS and HERS is a show-me story. Until they prove that their margins can hold up against this massive 2026 CapEx spend, and until they prove they can survive the FDA's scrutiny on this clinical necessity strategy without getting shut down, the stock is a value trap. The risk is simply too high. I think the Bank of America target of $29 is the realistic baseline, and there's downside to $22 if the FDA gets aggressive.
And I'd summarize it this way. The risk is fully priced in. At $31, you are buying a profitable brand with $2.4 billion in revenue potential for a bargain. The market is pricing in the absolute worst-case scenario that the weight loss business just goes to zero. I don't believe that happens. The upside case, a Novo deal plus a short squeeze, targets $60. The downside is limited by their cash flow generation. It is asymmetric upside.
It is certainly at an inflection point. We are watching a battle between the legacy compounding model that printed money and the future personalized platform that cost money to build.
Exactly. And the next earnings report is going to be the referee. We need to watch the customer acquisition cost trends. If CAC stays stable while they pivot, the bulls win.
And if CAC spikes, the bears feast. Analyst targets are all over the map, ranging from $29 to $44 plus. The market is confused, and usually confusion resolves itself with volatility.
We'll be watching the tape. The market is waiting for the next card to drop.
Indeed.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.